Most people think taking retirement income early is a mistake. But the real mistake is not understanding this one trade-off. If you're planning retirement at 60, you're entering the highest stakes period of your financial life. This is for the worker who feels the weight of retirement anxiety and needs a clear exit strategy. Today, we audit the age 62 trap. We'll cover the break-even math, the flexibility factor, and the longevity safety net. By the end, you'll see the one variable most people miss, the one that turns an early win into a long-term loss. Stay with me. Let's look at the books. Let's walk through the logic of claiming early. Picture two paths. File A claims at 62. File B waits until 67 or 70. File A gets a smaller check right away. File B gets a much larger check later. The common thinking is, I might not live long enough to benefit from waiting. That's fear talking, not an audit of reality. Here's the truth. You're not just planning for your death, you're planning for your life. If you live to 85 or 90, the early money from File A is long gone, but the smaller monthly check, that stays forever. Assume a 30% reduction for claiming early. That's 30% less for healthcare, 30% less for housing, 30% less for basic dignity in your final decades. Taking the money early feels like a win today, but it's really a short-term loan against your oldest, most vulnerable self. This isn't just about totals, it's about purchasing power. Inflation doesn't care about your break-even math. A check that's 30% smaller today could buy 50% less in 20 years. Claiming early because you don't know how long you'll live. That's fear not data. You're betting you'll die young just to win the system. We're wired for instant gratification. $2,000 today feels better than $3,000 later. You don't relate to your future self. That version of you feels like a stranger. The money hits your account. You feel relief. The anxiety drops for now. Audit your family health history, not the stock market. If your parents lived into their 80s, assume you will too. Plan for the worst-case success living too long. Retirement is a 3-0-year project, not a 5-year break. If the last decade fails, the plan fails. Calculate your age 95 budget. Assume limited mobility. Assume higher care costs. Take your current grocery and utility bills, multiply by 1.5. If your projected check is $1,800 and your future costs are $2,700, you have a gap. Using early retirement income to fund a lifestyle you can't afford yet. This is the new freedom trap. You've worked 40 years. You're tired. You feel like you deserve the cruise, the new truck, the move to the coast. So you use early income to bridge the gap. It feels like a reward. But it's not. It's selling your future security to pay for today's comfort. Separate floor income from fun income. Your guaranteed income covers survival, rent, food, taxes, insurance. Your savings cover lifestyle. If your floor isn't covered without claiming early, you're not ready. Create a floor-only account, no exceptions. Add up your must-haves. Car payment, Medicare, property taxes. If your truck payment is $700 and your check is $1,900, that's 36% of your life income on a depreciating asset, focusing only on break-even age. You think, if I don't live to 78, waiting wasn't worth it. So you take the money now. Calculators make this feel like a bet. You think you're playing a game against the system. You don't want to lose by dying early. But you're ignoring the long tail, the years where you're old, can't work, and need stability. Focus on payment size, not lifetime total. At 85, you won't care what you've received since 62. You'll care if your monthly check covers your life. Bigger payments protect you from inflation. That's the real hedge. Compare monthly income at 62 versus 70. Ignore totals. Focus on the gap. If the difference is $1,000 a month, that's the gap between surviving and living. That $1,000 is your dignity at 85. Believing your expenses will drop after you retire. No commute, no work clothes. You assume you'll spend less, cook more, stay home. But free time is expensive. Use the first-year buffer. Retirement isn't slowing down. It's gaining 40 hours a week to spend money. Travel, hobbies, home upgrades, they add up fast. Your first years will likely be your most expensive. Track your last 30 days of Amazon and DoorDash spending. Double it. If you spent $400 this month, assume $800 in retirement. More time equals more spending. That's the reality. Ignoring the impact on your spouse. You feel the burnout. You want out. You think, we'll enjoy it together. But claiming early locks in a lower survivor benefit, the highest earner waits rule. If you earn more, your decision protects your spouse. Waiting increases the household's safety net no matter who lives longer. Compare your benefit to your spouse's. $3,000 at 70 versus $2,000, $100 at 62. That $900 difference follows your spouse for life. That's a permanent cut? Claiming early while still earning income. You want extra cash flow. It feels like you're getting ahead, but the system pushes back. Run a tax efficiency audit. Don't claim while your income exceeds limits. You lose part of your benefit. And higher income can raise Medicare premiums. Check the current earnings limit. Earn $30,000 when the limit is $22,000? You're giving money back. That's not strategy. That's leakage. Believing you only need 70% of your income. It sounds achievable. It's what you've been told. But it ignores rising costs, especially healthcare. Aim for 100% of spendable income. Expenses don't disappear. They shift and often rise. Compare your net pay to your projected income. $5,000 take home versus $2,000. $500 check. That's a $2,500 gap. Where does it come from? Savings? For how long? Claiming early to avoid touching investments. You want to protect your portfolio. You want it to grow. Use the reverse harvest approach. Spend some savings now to secure a higher guaranteed income later. Your investments carry risk. Delayed benefits offer a guaranteed increase. Price out a private annuity equivalent. A $1,000 monthly guaranteed payment costs a fortune privately. Waiting gives you that at a much lower cost. Retiring at 62 without a plan for 62, 65. You've always had employer insurance. You underestimate the real cost. Create a dedicated healthcare fund. Do not rely on your retirement check for insurance. Get a quote from the ACA exchange. If insurance costs $1,000 and your check is $2,000, you're living on $1,000. That's not retirement. That's survival. Using early retirement to escape a job you hate? You're burned out. You want out now. It feels like pulling the emergency exit. Transition. Don't terminate. Change jobs, not your long-term income. Keep your benefits growing. Update your resume for a lower stress role. A part-time job covering bills lets your benefits grow. That growth compounds into a massive raise later. The earlier you take the money, the less freedom you may have later. You think you're buying independence at 62, but you may be locking independence at 82. This isn't now versus later. It's easier middle years versus harder final years. The system rewards patience. It builds a floor you can't outlive. Claim early and you trade that floor for a short-term escape. This is a system problem, not just an income problem. Audit your exit. Don't guess. Don't follow the crowd. Most people act out of fear. You act from data. This week, write your enough number, the minimum monthly income you need. This month, estimate real expenses. Include everything. Add a 20% buffer. This year, build optional income. Even $500 a month changes your timeline. It gives your main benefit time to grow. Every dollar earned today is worth more later because of delayed growth. Would you rather take less money now to escape a job you dislike, or maximize your income to protect your 5-year-old self? Tell me your why. Are you betting on a short life or preparing for a long one?